Welcome back, everybody. So obviously when we've got years or even decades to invest in, we want dividend stocks that are going to grow as a company as well as continue to provide us with ongoing increasing dividend yields and dividend payments. So stay tuned. I'm going to go over 3 really nice options here that are going to grow your dividends this year, next year, and for years and decades beyond. This is a great option for investors in their 20s, 30s, or even 40s looking to save for and invest for retirement. So stick with me. Let's get into it. Now, in the comments box below, let me know if you have any of these companies in your portfolio and what you think about these picks. And don't forget to hit that subscribe button so that you can learn more about the opportunities to grow and develop your financial future with me in 2023. So hit the subscribe button and let's get into it. Okay, so first off, Microsoft. So this is a company that has been wildly valued in recent years, hitting about 40 times price to earnings multiple. Now looking at a much more reasonable sort of 25 times now. So what does this mean? Is it a reasonable value at this point? And the answer is sort of yes, maybe. So this is one of the world's largest companies. It's one of the world's strongest financial companies. It does have a slow and steady growing dividend as well. And so let's look at some of the details here. First off, let's look at some of the future forecast returns. If analysts have the earnings estimates correct and prices continue to maintain this roughly 28 times price to earnings, we could be looking at a total rate of return of about 62% to the end of 2020 or mid-2025, or an annualized return of 21%. On top of that, we get some nice dividend yield increases as well. Now, when we look at past performance for the dividend yields, it's been rising at about 10% per annum over the last several years, and it has a compound growth rate for the dividends of about 19% over 19 years. So an investment in 2002, 20 years ago, would have had compounding growth of about 11.7% as opposed to the S&P 500 of 7.7%. Now this is a company that is expected to continue to grow. I'm over here in Finbox now, and we're looking at an analyst price target of about 300 compared to the current prices of about $240 presently. Using a range of different models, I estimate about $287 as a fair value, giving us about a 20% upside and some very strong long-term growth opportunities and prospects here. So the analyst targets as well extend from about the current price now through to about $400 as a price target, which seems to me a little bit excessive, but there we go. Now, one of the things I do like about Finbox is their ability to drill down into some of these analyst estimates. And here we have the analyst estimates for EPS, and we can see that if we look at the average forecast for the EPS, we've got some incredibly strong growth moving forward. And that's what I like to see with a long-term pick like Microsoft. Long-term growth. And now for the second pick, for long-term dividend growth, we have Innovative Industrial Properties, or IIPR. Now, this is a company that was on an absolute tear in 2020 and 2021, hitting about price to adjusted funds from operations ratio of about 40 times at the end of 2021, and now is sitting at about 12 times today. So, what was going on? Well, if we look at here, the AFFO was growing at extraordinary rates, 144% in the year, 53%, 33%. Now what we see going forward is this growth is slowing down quite considerably now to 25% for 2022 and only 4 and 11% expected growth in 2023 and 2024. So we have seen this price crash down like this. Now the big question right now, is this a good buying opportunity for us? Well, the big, strong growth in AFFO has gone, and AFFO is essentially the same as the earnings, but more appropriate for looking at a REIT, like IIPR is. So what we can see here is I've got this switched to about 15 times in this orange line. If we begin to look out to the end of 2024, so 2 years from now, we're talking about a total rate of return of about 57% or an annualized growth of 25%. Now, it has a current dividend yield of 7%, so it's going to juice up your payments, but you can see here that the dividend increases are slowing down quite a bit compared to what we've seen in the past. So these are estimates of growth from about $7.10 to $7.40 to $7.95 over the year. So relatively slow growth here, but still high, and that's on top of a very nice, very juicy current dividend yield at the moment. So IIPR, $100 roughly at the current share price. Analysts have it roughly targets at about $140 through to $200 with a current target of about $161. Using some financial models, I'm talking about a target of about $145 for the fair value with a range of perhaps $122 to $160. There is a relatively high level of uncertainty here. A lot of this is going to depend on their future growth trajectories. But if we look at this financial model here and the estimates of about $145 a fair value, which is relatively conservative compared to the analyst estimates, we're still talking about 44% upside and some really nice long-term growth in dividends. And now, my friends, my third and final pick here for long-term growth, Toronto-Dominion Bank. So as you can see over these three picks, quite a bit of diversification: technology, real estate and financials. Now, I do prefer some of the Canadian banks over other banking systems. They tend to be quite conservatively managed, and they do tend to have a relatively consistent growth over time. So here we can see the historic chart. We can see this blue line representing the normal historic price to earnings multiple here, running at about 12.55. We can see at the moment in the last year, we can see the prices have declined quite a bit below that blue line. At the same time, we can see the white line representing dividends has continued to increase. So what are we looking at here? We're looking at a large bank, $117 billion market cap, but also with a very strong S&P credit rating. Okay, so forecasting future returns. So I've switched this blue line to the normalized price to earnings ratio of about 11.25, which is what Toronto Dominion Bank has had over the last 5 years. So if we assume that they hit this by the end of 2024 financial year, we're looking at a total rate of return of about 31% or an annualized rate of return of about 15 to 16%. Now, when we look at what this means, we're still talking about a nice dividend yield of 4.25%, and we've also got some fairly reasonable dividend increases here expected to come in at the future as well. Now, the company itself is looking to grow, or the analysts are expecting the company to grow the earnings per share by about 7% in the 2023 financial year and about 5 to 6% in the 2024 financial year. So we're talking about a company with some nice growth opportunity here and a reasonable dividend yield that is also growing. Now, how is the company going to fare in the future? If we switch over to FastGraph's long-term growth chart, we can see that analysts have an expectation here of long-term, over the next 5 years, annualized growth of about 8 to 9% per year. So we're talking about a company with some fairly good growth prospects ahead. So are we buying this at a good price and looking at it at a good price today? So we're talking about a current share price of about $64 to $65. We're talking about analyst price targets here of around $63, so a little bit lower than where we are now, through to $73 with an average price target here of about $69. Now, if you're looking at the financial models, there's a fairly tight spread here suggesting that the company's worth about $73 to $79 a share. With about here then 17% upside, although if we're looking at the analyst price targets, we're talking about less upside. So we are talking about a fairly strong company here. It's got some good long-term growth potential and opportunities, and it makes a nice diversification and complement to the other companies that we've looked at. So my friends, stay tuned. Many more good deep dives into some stocks coming up. This is not the end. 2023 is looking to be an exciting year. So hit that subscribe button, send me a comment down below, let me know what you think about these 3 stocks and are they in your portfolio? Which ones do you think could be substituted out or other companies swapped in? Let me know. I look forward to hearing from you soon. This is Lincoln signing out.